Welcome to Real Vision. It's Wednesday, October 21st, 2020, just after market close in New York. This is the Real Vision Daily Briefing. I'm Ash Bennington, joined shortly by the Daily Dirtnap's Jared Dillian. But first, with the day's stories, Nick Correa.
Thanks, Ash. Yesterday, the Conference Board released the results for their measure of CEO confidence survey for Q3, and it reads at 64, up from 45. Up 19 points from last quarter, the data demonstrates a significant hike in the outlook for CEOs, the first time where responses have been more positive than negative since 2018. This contrasts sharply against the more feeble change in consumer confidence numbers from the previous quarter, which are still below pre-pandemic levels. 25% of CEOs reported that they anticipate increased capital spending over the next 12 months, which is up from 15% earlier in the quarter, and 36% stated that they anticipated upward revisions in capital spending beyond the next year. 70% believe that economic conditions were better now than they were 6 months ago, which is up from 8%, and only 21% said that they were worse, which is down from 90%. In terms of their short-term outlook, 64% said that economic conditions would improve over the next 6 months, and only 15% expect them to worsen. Regarding employment over the next 12 months, the results were more of a mixed bag, which may affirm more long-term tribulation for labor markets and the uncertainty that consumers are currently experiencing. 34% reported that they foresaw a net reduction in their workforce, and an additional 34% anticipated no change. 62% expected little to no problems in finding qualified workers, with 11% saying that there were more broad-based talent shortages or hiring problems. 21% reported that they did not foresee an increase in wages, and 5% said they may reduce wages. This yet again points to the bifurcation of the financial and the real economies and how the recovery may in fact be K-shaped. The proliferation of special purpose acquisition companies, or SPACs, this year is evidence of that sort of recovery, and the latest in the SPAC trend are talks between Michael Bloomberg and Bill Ackman, taking Bloomberg LP public through selling a minority stake to Ackman's blank check company, Pershing Square Tontine Holdings. A few months ago, Ackman listed the SPAC on the New York Stock Exchange and raised $5 billion in order to buy or merge with another company, which enables that company to take the SPAC stock listing. A spokesperson for Bloomberg LP denied that a deal was being explored, and Ackman declined to comment. However, should a deal between Bloomberg and Ackman come to fruition, it's positioned in such a way that Bloomberg would not have to relinquish his 88% ownership stake in his company, but still provide enough float. Not only could the terms be favorable for Bloomberg and his company, it would also allow the investors in Ackman's SPAC a stake in this major media company for $20 a share, which was the SPAC's IPO price, and it would become one of the most successful SPACs yet. And with that, I'll send it back over to Ash.
Jared, welcome back.
Hey, thanks for having me.
It's great to have you. Jared, we were talking off camera a little bit before we got started here about risk and stress in markets. It seems like a very pertinent subject for where we've been for the last several months. What's your thought on that right now?
Yeah, I have some different opinions on this. Most people, when they trade, they seek to maximize return. And they look at returns to the exclusion of all else. I mean, even if you have retail investors that are looking at mutual funds, they look at the returns. They say this one returned the most. Nobody goes into the prospectus and looks at the standard deviation. Nobody looks at the risk of these funds. They only think about returns. When you have a guy like Dave Ramsey, who says to his followers that you should invest in aggressive growth mutual funds because they return the most, but there's no discussions about risk. So one of the ways I manage my financial affairs is that I pay very close attention to risk. And I want to get to a point psychologically where not only am I not staying up at night worrying about my positions, I'm not thinking about it at all. And it's very rare. I mean, you have to go back to March when we were melting down. I was experiencing a little bit of stress, but there's very few times in my history where I have experienced a lot of financial stress.
Yeah. So what are the first things that you look at? For example, you used the example of a mutual fund. What are the first things that you look at when it comes to evaluating risk? And how does that relate to how you think about the psychological aspect of the stress?
It's really about portfolio construction, okay? And If I go buy all the FANG stocks, I have a very concentrated risk in one factor. Okay, so when I build a portfolio, I like to take positions in a number of different factors, including offsetting factors. And that helps reduce my overall risk and my overall volatility.
Yeah, this is something that I think is very broadly misunderstood by people who are relatively new to the space. The idea that portfolio construction is not just about the absolute risk of the underlying constituents, but about how they offset each other and the potential to balance in the event of events that hit one or the other of the constituents of the portfolio.
Yeah, and the other thing is that in times of market stress, your portfolio will behave in ways that you cannot predict. Things that weren't correlated will become correlated. Things that were correlated will become uncorrelated, and a lot of the hedges that you put on will stop to work. Will stop working. So you really have to focus on building a portfolio that is immunized from volatility.
Yeah, I think probably the most obvious example of this is the conversation around the risk parity trade breaking down a few months ago.
Yeah, I mean that's a function of the treasury market. I'm looking at my portfolio here, and it's a grab bag of stuff. I have gold, I have brick and mortar retailers, I have Beyond Meat, I have Canadian banks. I mean, it's just like it's all stuff that is very uncorrelated.
Right. And how do you measure that lack of correlation? What are the tools that you use to structure that portfolio?
I mean, one of the things with me is I'm a very unquantitative guy. Even after working at a bank and doing a lot of stuff in spreadsheets and being mathematical, I've sort of given that all up. I consider portfolio construction to be an art rather than a science. And I think it's a function of experience. It's something that you get better at over time. I'm still trying to get better at it, but I don't have any quantitative tools to evaluate my portfolio. It's just all experience.
So then, what are some of the qualitative tools? How do you think about making those allocations? And what are the guiding principles that you have that your experience has taught you work well?
So one of the things I do is when I'm adding a position to a portfolio, I don't think about the position on a standalone basis. For example, if I let's just say Google, okay? A lot of people, when they buy a stock, they say, I like this stock, but they don't consider that stock as a contribution of risk to the overall portfolio. You can't just look at it on a standalone basis. You have to look at how it interacts with everything else. And when I say I minimize my financial stress, like I really, I don't just minimize my financial stress. I really don't even think about my portfolio. I don't think about it for days at a time.
That's interesting. So when you do, for example, Google, do you then look at other members of that sector and think I might not want to be in that, or I might want to be in that to a lesser weighting, finding a sort of a best in class for a particular sector and subsector, and then avoiding the rest of it? How do you think about it?
No, actually, that's exactly what I do. And I don't just do it with stocks. I do it on a macro basis. I do it with FX and rates and emerging markets and stuff like that. So it all goes into the soup.
So it's a lot of different asset classes. How do you think about your asset allocation from an asset class level?
Well, my ideal asset allocation is 20% stocks, 20% gold, 20% bonds, 20% real estate, and 20% cash. That is the ideal asset allocation. And I try to stay pretty close to that. I'm not religious about it. I try to stay within 5 to 10% on each of those asset classes. That's a proprietary portfolio that I developed. I called it the Awesome Portfolio. And that portfolio over a period of 48 years returns 8.4% a year with half the risk of an 80-20 portfolio.
Half the risk.
Half the risk.
Yeah. And it's interesting, those asset classes. First of all, talking about real estate, how do you get exposure to real estate?
Well, for a lot of people, I actually would consider the equity in your own house as your exposure to real estate. And for me, the equity in my house, I own my house free and clear, so it's about 20% of my net worth. So that's my allocation to real estate. If I start getting more liquid assets, then I start looking at REITs or REIT ETFs. That's how I get exposure.
So you do it through liquid assets in the capital markets.
Yeah. Or you could do real estate on an idiosyncratic basis. You could buy a rental property. You could buy a commercial property. That would also be exposure to real estate. The problem with that is that it's very undiversified.
Right. Yeah. A particular property, much less diversified potentially than you could get exposure to in a REIT, for example. Yeah. And so let's switch gears and talk about the rates and currency side of the awesome portfolio.
Well, the bond side is 20% of the allocation. And that's difficult right now. I mean, the treasury market is an absolute horror show. Nobody should be investing in treasuries right now. I have a pretty high allocation to high yield and preferred stock. That was something I put on back in February or March. So that's how I get my exposure to fixed income. Investment grade corporates, munis, high yield corporates. I mean, my view on the credit markets is that they're going to be supported by the Fed for many, many years. These liquidity facilities that the Fed put in place back during the crisis, they don't end those after 6 months. It's going to be in place for 5 to 10 years. So a lot of people, they draw charts of HYG and they're like, oh, HYG is breaking down. And I'm like, nothing's happening. Like it's going to be fine. So you can be in investment grade corporates or high yield, and you can clip coupons of 3, 4, 5% pretty safely.
Yes, this is the iShares iBox high yield corporate bond ETF, and I'm curious: is the thinking there that this is an implicit backstop from the Fed? Is that why you believe that it's going to endure over the longer time horizon?
Yeah, and that was actually the rationale for putting it on. It was in the very early days of the crisis.
Before they announced.
One of the things I wrote about in the newsletter was that the Fed is going to backstop credit. They're going to backstop the corporate bond market. If you recall, liquidity had totally frozen up. Prices gapped down 30 to 35%. The ETFs were trading way below the NAV, and the corporate bond markets were broken. So the Fed fixed the corporate bond markets, but of course, the Fed takes everything to an extreme, and now everything is massively overpriced.
Yeah, so that was seen as a departure by many. I'm curious what you saw that allowed you to anticipate that the Fed was going to be moving in that direction. Was it just because this has been the way it's been with the Fed? It's just a continual slide to greater and greater intervention, and it was the next domino to fall?
Yeah, that's what I believed. But in that particular case, it was the fact that the corporate bond markets had just ceased functioning. They had ceased functioning. Nothing was trading. They were broken. Right. So when the Fed wasn't acting because they thought corporate bonds were underpriced, they were acting because the liquidity mechanism had totally broken down.
Yeah. And it's interesting. What's your outlook going forward? Is it effectively just that central banks are going to continue to support that market and they're not going to trade based on price discovery, but by virtue of the intervention?
Yeah, I mean, and there's all sorts of unintended consequences. I mean, we're already dealing with zombie companies, right? Like companies that should be bankrupt. I mean, the unintended consequences of this are just horrifying, and they'll continue to be horrifying, but they're going to continue to do it.
Does that give you pause as you look out across risk assets that there might be a moment of reckoning at some point, or is that still down the road because there's more ammunition left in the gun?
Yeah, I think that's very, very far down the road. I don't think that's anything that we need to worry about in the next 5 years.
Yeah. Another thing we were talking about offline was Bitcoin and obviously the announcement coming out today about PayPal. This could be potentially a game changer. I think I wrote a couple of weeks ago when this was being talked about, that the number of people who are going to have access to direct custody or indirect custody through PayPal of those assets is going to climb dramatically for Bitcoin right now.
Yeah, I haven't even really thought through all the implications of it. I mean, it's pretty mind-blowing. The one thing I will say is that the story of the last couple of months is increasing institutional sponsorship of Bitcoin. You had MicroStrategy, you had Square, you had Stone Ridge, you had big institutions taking positions in Bitcoin. Every bubble, that happens. If you go back to the dot-com bubble in 2000, a couple thousand dot-com companies went to unsustainable heights. The bubble crashed. But then over the course of 20 years, the promise of the internet was actually realized. And the second phase was a giant, legitimate bull market. And the same thing is going to happen with Bitcoin. The bubble that we had in 2017, it flushed out all the speculators. And now we're having a real bull market that's going to last for many years.
Yeah, so many interesting points there. I'm curious how you think about the time horizons. Look, there were periods of years there where Amazon continued to decline off its 1999 highs. How do you think about the time horizons for something like this? Obviously, we saw a shakeout in cryptocurrency after the peak in 2017. How do you understand and think about those time horizons?
The one thing I think about is patience. And if there's anything I've learned over the last 20 years, it's to have a great deal of patience. And things take a lot longer to play out than you think they will. And one of the things I wanted to talk about with you was this concept of selling things too early.
Yeah.
Right? The biggest sin that you can commit in trading is selling things too early. In leaving lots of profits on the table. I have a great story. 2004. I wanted to get exposure to agriculture. Corn prices were going up. Wheat prices were going up. I couldn't trade futures at the time, but I wanted exposure in the equity market to agriculture. So I looked, and the only company I could find was this very small cap company called the Andersons. The ticker is ANDE, and they operated grain elevators. So I bought stock in the Andersons. Now, this was in 2004. Now, the interesting thing is that this stock was so small that it was not even in the Russell 2000. I was working on the program trading desk at the time, and I found out that the Andersons was a candidate to be included in the Russell 2000. So it was included in the Russell 2000. I bought the stock at like 26. I sold it at 34, thinking that the trade was over. And 3 months later, it was at 90. Never, and my whole thesis about agriculture turned out to be correct, but I sold too early.
So, Jared, here's the killer question for you. What do you know now that you did not know then that would have allowed you to hang in that trade and pick up that upside?
It's not a matter of knowing anything. It's just a matter of being older and having patience. Patience is, Bitcoin, we were talking about Bitcoin. Bitcoin isn't a 1 or 2 year trade. It's a 10 or 20 year trade, right? So, that's another, it gets back to what I was talking about earlier about stress. I really don't pay a lot of attention to daily fluctuations. If I have conviction in something over a long-term basis, I just let it play out.
What does long-term mean to you, Jared, on equities?
5 to 10 years.
5 to 10 years. And what percentage of your equity portfolio are you invested in with a 5 to 10 year time horizon as your target?
All of it.
All of it.
Yeah.
And do you trade tactically around that, or do you just have a complete allocation to a 5 to 10 year horizon where you really like the strategic view of the company?
No, I don't pay a lot of attention to entry and exit points. I don't pay a lot of attention to technicals. I used to be better at that. I used to fancy myself this, sentiment trader and buying on panic and stuff like that. But I found that I'm not as good as that over time. So I'm not very scientific about it. I just take a position and I leave it on. And if it goes in my favor, then I will add to it if I have capacity.
And how do you psychologically find your way to doing that and not hitting the panic button the moment you see bad news and a 5% decline, for example?
The way I look at it is if the fundamental story has changed, okay? If there's been a fundamental change in the thesis, that's when I will exit the trade. But usually that doesn't happen. Usually the thesis is pretty sound.
And if there's not, you just shake it off and close the browser.
Yeah, pretty much. Yeah.
Another thing that we were talking about offline is this idea of betting against America. What does that mean to you?
Okay, so first of all, this isn't my idea. Okay. I got this from Jawad. Okay, Jawad tweeted this out about a month ago. And it took about a month for it to percolate in my brain and to really, really think about this. And what he tweeted out about a month ago was he said, if you were bearish on America, if you thought that America was going down the tubes, you would buy stocks. not sell stocks. You would buy stocks. He said that's not a typo. You would actually buy stocks. There is no better way to bet against America than buying stocks.
What's the logic behind that thesis?
Well, the logic behind that is that, if we want to get into politics a little bit, we got the election coming up. If Biden wins, we're going to get lots of spending. If Trump wins, we're going to get a little less spending. Either way, we're living in this MMT world. And, if we have a Democratic sweep, if Biden wins, the Senate goes Democratic, the House, and they get rid of the filibuster, there's no check on spending whatsoever. Biden has said that he's going to spend $7 trillion above and beyond what's already being spent in the budget, $7 trillion over the next 10 years. I think that happens in the first year and then some. Okay, so if we're spending this money and we're going into debt and the Fed is indirectly monetizing it through quantitative easing, then that is how stocks go up, because stocks are a store of value. You've seen this in several instances around the world. What we're doing, if you want to talk about MMT philosophically, all it is currency debasement with an academic veneer. What we're doing here is really not that different from what's going on in Argentina. Argentina has 100% inflation. The central bank is financing 60% of government expenditures. Like, this is our future. So in such an environment, you buy stocks as a hedge.
As a hedge against inflation, because the rate is, as the currency declines, the nominal value of the stocks will increase.
So a lot of people have been having trouble with this over the last few years. The way they think about this is they say, I'm bearish, so I'm going to buy puts. I'm going to sell SPOOs. I'm going to make these bearish bets. And over the last couple of years, the market has gone up. And America, from a quantitative and qualitative standpoint, has objectively gotten worse in pretty much every respect, and stocks keep going up. If you wanted to bet against America, you would actually buy stocks.
Yeah. Something that I think is interesting, Vice President Biden now proposing the $7 trillion package. I remember, I guess I'm old enough here to remember the $700 billion in 2008 being something that people hemmed and hawed over, up an order of magnitude.
Yeah, I mean, $780 billion, that was Larry Summers. They called it the I forget what they called it, but people called it the porculus, right? And it was all this infrastructure spending, and basically we paved the same roads over and over again. And, that's also in our future. I mean, if you want to talk about infrastructure, this country doesn't do infrastructure very well. Yeah. We don't do it very well because of the permitting process and stuff like that. Stuff takes years and years and years. So, it's a lot of, we're going to be paving a lot of roads.
Yeah. I mean, it's just, there was so much hemming and hawing about it, right? The word unprecedented, I must have heard, like 10 times a day about this unprecedented 700 and some odd $billion coming out of stimulus. And, now it seems quaint, doesn't it?
Yeah, it does. And the multiplier, they calculated the multiplier on that stimulus, and it was 1.03. So it really, it was ineffective, but we're going to be doing the same thing.
Well, at least it was greater than one. Talking of other sort of things that I thought seemed potentially like ominous signs, I was talking, I guess it was the day before yesterday, with Ed Harrison about the about the print in China, 4.9% GDP growth. This effectively is China back on trend. The United States still considerably below trend. China accounting for 30% of global GDP growth in 2020. The idea that the great, mighty American economic engine is not leading this recovery, is not leading the way out of this crisis, is something that I think is pretty ominous.
Yeah, I mean, that's kind of a philosophical question. It's, I think that, back when, Trump has sort of bragged about the economy under his watch, we've consistently had 3% GDP. If you went back to the Clinton years, you had 4% GDP. If you went back before that, we had 6% GDP. Growth has been going down over time. Partly that's a function of demographics. Partly that's a function of regulation. I think going forward, we're not going to get those eye-popping GDP numbers. They're probably going to be below 3%.
Yeah, and the prints have been way down, obviously, as a consequence of the crisis. Now, this isn't structural, this isn't trend, but on a cyclical basis, because of the massive hit the economy has taken, substantial. I mean, you look at that chart of GDP. I don't know if we can put it up, but if you look at the 2008, 2007, 2008, 2009 period and compare it to what we've got now, it looks like a blip in terms of those negative prints.
Yeah, I mean, and back then, back in 2008, we had, I believe it was -6% GDP, which was the lowest that we had since 1982, and we're exceeding that now.
Yeah, it looks like Q2 2020 minus 30+%.
Yeah, and that's a little misleading because that's an annualized number and it's a quarterly number, but yeah.
Yeah. So, but even a quarter of that, it's still significant.
Yeah.
These are big hits.
Yep.
So, other thoughts, Jared? What else are you looking at today?
I want to talk about trend following a little bit. I one of my core beliefs is that people are either born trend followers or they're born mean reversion people. And you're just wired that way, and you can't help it. I'm a mean reversion guy. That's how I was born. When I started investing in 1997, when I was 23 years old, it was the late 90s, and I was getting Money Magazine from the grocery store. And they had these lists of mutual funds. And they had these science and technology funds. That's what they called them back then, science and technology funds. And they're making like 30, 40% a year. My thought process at the time was, that's not sustainable. I want to invest in the funds that are bad because they're probably going to recover. So I invested in value stocks. So in the late 90s, I invested in value stocks. So I missed out on the last half of the dot-com bubble, but from the period of 2000 to 2003, I did great.
It's like being born left-handed?
Yeah, absolutely. So over the last 5 years, I've tried to become a trend follower, right? Because ultimately, I think that is how you make really, really big gains, is being a trend follower. And it does not come naturally to me. So that's where we get into what we were talking about before, about taking positions for a really long time, adding to winners. That it does not come naturally to me. It makes me very uncomfortable, but I'm trying to learn that.
How did you make that shift? That's a pretty significant shift in the way you view the world.
I think there was, gosh, I don't remember how long ago this was. It was Stan Druckenmiller was speaking at an event, okay? And the transcript of his talk made it out on the internet. And I started reading about his investing style, and I said, this is it. This is how you do it. And I was totally converted. So, I mean, the thing about being a mean reversion guy is that you have small gains. You have consistent gains, but you have small gains. But to make super normal returns, you have to be a trend follower.
Yeah. So we've talked about some of the big picture points here, how you view markets, what your toolkit looks like. Where do you think we are right now, and what's your outlook for the future?
We have this thing called the election that's happening in 2 weeks. I like to refer to it as an event horizon, like with a black hole, right? We can't see what's on the other side. Like 2 weeks from now, things are going to be totally different. Now, we do have some idea, okay? We do have some idea. The market is pricing in a Biden victory unquestionably. Like, that's happening, okay? Doesn't matter what my opinion on it is. Doesn't matter what I think about it. That's what the market is pricing in. Solar stocks wouldn't be up 350% in 6 months if the market thought that Trump was going to win. So you can sort of prepare for this, and you say, what kind of things are going to do well under a Biden presidency? We just talked about spending. We talked about infrastructure. Gold is going to be a consistent theme. Bitcoin is going to be a consistent theme. And beyond that, it gets a little bit more complicated.
So what are those complexities, and what are you at least thinking about, even if you haven't teased out the exact answer?
Well, one of the complicated parts is energy, because people's assumption. Remember, I said that everything takes way longer to play out than you think. California banned internal combustion engines as of 2035. They think they can get rid of gas-powered cars in 15 years. That's a bit ambitious, okay? We are still going to be driving cars in 2035. We're going to be driving cars for 100 years, okay? So under this thesis that things take a lot longer than you think, I think that we probably have one or two more energy bull markets while I'm alive, and that they're tradable. But my concern is that, under a Biden presidency, what does it mean from a regulatory standpoint? Is this bad for energy stocks? So it's very complicated.
If I had to guess, the thing that's going to get rid of in California by 2035 is probably some of the language around that legislation.
Yeah, probably.
Jared, final thoughts as you leave us here.
Well, I think things are going to be kind of soporific over the next 2 weeks. It's going to be a little bit boring. What we had in 2016, what the election result was a surprise, and it wasn't priced in. So then the market aggressively priced it in over the next couple of weeks. This time, it's mostly priced in unless we get a surprise. So barring a surprise, it's going to be interesting to see how much of this is already priced in and if there's a pullback.
Yeah. Jared Dillian, Daily Dirtnap. Thanks for joining us.
Thanks.